Okay, so the overall objective of the audit, remember, the auditor is there, okay, to verify, okay, or to test, okay, whether the financial statements are free from material error. Okay, so in doing that, the auditor has ethical requirements, okay, that needs to be maintained. Okay, and the basis of that is encapsulated in our code of professional conduct. Okay, when the auditor is setting out, okay, to test the financial statements, okay, in terms of the assertions that management have made, okay, so that he can provide an appropriate conclusion of whether the financial statements are materially misstated or not. Okay, he needs to execute those audit tests or those audit procedures with professional skepticism. Okay, so professional skepticism is basically just a questioning mind. Okay, so that means not accepting everything that the client tells you at face value. Okay, so that means that the auditor needs to make a critical assessment of each piece of audit evidence. Okay, and he needs to be very alert when he's performing his duties, okay, so that he's able to pick up any conditions or events which may indicate a possible misstatement. Okay, in executing his duties, the auditor needs to apply his professional judgment. Okay, the professional judgment means that the auditor is not always just rule bound to say he needs to tick off certain boxes, but he needs to apply his judgment in terms of how much to test, what the risk of material misstatements are, and how to appropriately respond to those risks. Those are just examples of where the auditor needs to apply professional judgment. Okay, and the auditor also needs to make sure that the ISAs, that the audit is conducted in accordance with the ISAs, and the evidence that he has obtained is sufficient and appropriate. So ISA 230 governs audit documentation, and we have just said that the auditor, in conducting his audit and to achieve the audit objective, the auditor needs to perform certain procedures. Okay, so these audit procedures need to be documented because they form the basis for the audit opinion. Okay, so that is like writing an essay and you have to get to a certain conclusion, okay, or you want to get to a conclusion, but you need to have the body of the essay as well, and the body of the essay is then the audit documentation. Okay, so the audit documentation needs to show or provide evidence that the auditor has complied with the ISAs. Okay, so the audit documentation, we usually refer to them as working papers. These are just the documenting of what exactly the auditor has done, what tests he has performed, what evidence he has gathered. Okay, so the audit documentation of the working papers, they also need to indicate that the audit has been, the working papers themselves, the evidence, have been prepared on a timeliness basis and they have been appropriately reviewed, and the information that has been included is appropriate, okay, provides an appropriate basis for our conclusion, which is our audit opinion, okay, and what we have tested. Okay, the audit documentation of the working papers need to, the trainees or the trainee auditors that are responsible for the working papers, they need to maintain confidentiality over those working papers, okay, because it is client information, and when the engagement letter is signed between the auditor and the client, there's usually a specific clause relating to confidentiality that the auditor will maintain confidentiality of the client's information, and then that needs to be carried down to at the appropriate levels of the hierarchy, up to every single person that deals with the client information needs to maintain that confidentiality. Okay, and that needs to be all then documented, and then a final audit file is compiled with all of these working papers that then can support our audit opinion. Okay, so ISO 500 guides us on audit, okay, and the sufficiency and appropriateness of that evidence, okay. So in terms of sufficient evidence, we need to have enough evidence to be able to support our opinion, okay. But with respect to appropriateness, that is a little bit more, would lean more the auditor to apply their professional judgment, because that would mean that they would need to obtain evidence that is relevant and reliable. Okay, once again, this must support our audit opinion. Okay, so in terms of the source of the evidence, okay, we know that external sources are more reliable than internal sources, okay? Written evidence is more reliable than oral evidence obtained, okay? And this is not just, this is right through the audit process, okay? So it's from the risk assessment procedures, the planning stage, through the execution phase of testing of controls or substantive procedures. The auditor still needs to maintain that professional skepticism, which we've already said is that questioning mind. Okay, so there are specific pieces of audit evidence for specific items on the financial statements that the ISAs require. Okay, so for example, the auditor's presence is required at the physical inventory count. Okay, where the auditor is not able to attend the count, the auditor is required to either attend a count. If the auditor is not able to attend the year-end count, the auditor is required then to attend a count at a different date and then perhaps perform roll forward procedures to the year-end count, to the year-end. And or if the auditor is not able to attend any of the inventory counts during the year, then there are alternative procedures that the ISAs require them to perform. Okay. In terms of litigation and claims, the ISAs also requires specific confirmations to be sent out to the legal counsel that represents the entity specifically. Okay. Segment information, the ISAs also state that these need to be verified and corroborated to the financial statements. Okay, so that they agree the appropriate disclosures are in agreement with each other. Okay, so for external confirmations, these are able to address specific assertions. Okay, so they are a piece of reliable evidence that the auditor has in their toolbox, which they can use to obtain evidence. Okay, for especially higher risk items, they would require external confirmations. Okay, for positive confirmations, there's usually greater reliability than a negative confirmation. Positive confirmation asks the confirming party to reply to the auditor, whereas a negative confirmation requires the confirming party to only reply in certain cases or where they have a disagreement with certain balances. Okay, so obviously there's greater reliability for a positive confirmation. In terms of the confirmation process, the auditor needs to maintain control over that process. The designing of the confirmation itself, okay, the control over the process. So at no point in sending out the confirmations, receiving back the confirmations, the client should be involved. Okay, the client does need to provide a consent letter for sending out these confirmations, but other than that, they're not involved in the process at all, and the evaluation of the results of the confirmation, that is all up to the auditor. Okay, so here we have some examples of external confirmations. The most common ones are bank confirmations, loan or debt confirmations, and then debtor circularization, okay, or creditors confirmation, sometimes also title deeds, share certificates. These are just a few examples of those confirmations that can be sent out. Okay, so ISO 510 talks up to initial engagements, and specifically with respect to the opening balances. The auditor needs to obtain evidence that the opening balances are not misstated, okay, that the closing balances of the prior year have been appropriately carried forward into the current year as opening balances, and that the accounting policies in the current year are consistent to the accounting policies in the prior year, and that they're also consistent with the IFRS. Okay. So the audit procedures that the auditor can conduct depends on the nature of the accounts and the risk of material misstatement in the current year financial statements, as well as the materiality of the opening balances in relation to the current year balances. Okay, so if there was an auditor in the prior year, we could, as current year auditors, consider relying on his work if we are able to review his work in papers. Okay. If he provided a modified opinion, we need to consider that effect on the current year. If those balances still exist, they may be material in the current year, and we may have a modification as well. Okay. But if there was no auditor, or we are unable to place reliance on the auditor's working papers, we would need to perform additional procedures in the current year relating to the prior year balances and transactions. So we would need to confirm balances with third parties, perhaps send out debtors confirmations, not just for the current year balances, but for prior year as well. Same thing with creditors, and then doing some additional procedures over prior year transactions. Okay, then making sure that our opening balances or performing procedures on the opening balances. Okay, so just remember that where we are contacting the predecessor auditor, the client needs to give permission to do that. We need to then consider also where we are reviewing his working papers, and we're able to place reliance on his working paper. We need to consider the effect on our financial statements and on our audit report as well. We may not make any mention of the prior year auditor in our audit report. Okay, we can, however, state that this is the first time that we are auditing this client, but we cannot make specific reference to a prior year auditor. Okay, in terms of analytical procedures, ISA 520 just guides us in terms of what is the nature of analytical procedures. We have already discussed this when we were doing our audit processes in the beginning of the year, but do remember that we can use this throughout the audit, from the planning to substantive procedures to the overall review phase, and this is just then analyzing the financial statements and coming up with trends or examining relationships or making comparisons so that we are able to identify risks where there are risks, or we are able to obtain evidence. For example, if we are able to create an expectation of what from the rental contract, what we would expect rental income to be, and then compare it to what rental income actually is, we can then identify where there are unusual trends or unusual relationships or misstatements, and we are able to investigate that accordingly. Okay, so in terms of auditing accounting estimates, okay, just think of an estimate that is, for example, if you're thinking of depreciation, that would then be the useful life or the residual value or the method of using up benefits of that asset. Okay, or think about the allowance for credit losses, where we estimate a certain percentage of our debtors would in all likelihood not be able to settle their accounts. Okay, these items, these accounting estimates, usually have a higher risk of material misstatement due to the uncertainty. It's an estimate, so it is not a factual figure. Okay, it involves the use of management judgment. Okay, and then it could also be prone to management bias. Okay, it's prone to management bias because management could use their professional judgment or their judgment to their best advantage. For example, understating the estimate for the allowance for those debtors which we would presume to be irrecoverable, okay, so that we recognize a lower movement in the provision and thus a higher profit for the period. That is something that management could do. Okay,